So this is definitely a presentation that is evolving. This slide deck, we want to continue to add to it. We're going to add some links to some of the sources for the information that we're going to present here today. And eventually you'll be able to get it on our website and download it. And then you'll be able to explore the sources yourselves. But today we're kind of doing an overview. We're going to touch on a lot of points. It's, like I said, very comprehensive. Hopefully we have time to go over it as much as we can. And so hopefully the point of it is to give you some actionable items, like how should you be responding in light of this information? What can you do to secure your ability to recapture deductions? So without further ado, I will go ahead and begin this presentation. So first of all, the foundation of 280E, which this is definitely a 401 level college course, if you were to put a label on it. So most people know what Controlled Substances Act is, and therefore what 280E is, and how that has impacted the industry. And so I don't necessarily want to get into the nitty gritty about the Controlled Substances Act, its definition of what is trafficking, and essentially why cannabis is Schedule I, or if it should be or not. But I'm going to go ahead and move on. I'm not going to spend too much time on this because you ought to know this by now. And you probably wouldn't be watching this if you didn't have an understanding of what the Controlled Substances Act is and 280E, and how 280E relates to the Controlled Substances Act. All right. So, as you know, like what you may not know, and I'll touch on, is 280E, which doesn't allow you to deduct overhead costs, essentially, is very burdensome, more for some businesses in the cannabis industry over others. Farms have a lot more ability to write off deductions as cost of goods sold than, say, dispensaries do. And so therefore, at least early on, before we had tools to be able to mitigate the impact of 280E, dispensaries specifically were suffering tax impacts of 70 to 90% effective tax rates. And actually, I do want to go back a little bit, and I want to tell you a little bit about our history of how we've been addressing 280E and where we were, say, back in 2014 when we first started to really get into when the Oregon market, for example, because that's where we're at, started to roll out dispensaries. And when we would go to do these tax returns, and all of a sudden we're like trying to apply 280E to it, and we recognized very quickly that this is unsustainable. If we were to file a tax return that is properly prepared within our surface understanding of 280E, then these guys are paying $70, 70% to 90% effective tax rates on every dollar. So 70 cents to 90 cents for every dollar that they made would go out to tax. And that immediately would bury them in tax debt or potentially put them out of business. So we definitely had to go to work at that time to figure out what are we going to do about this. And I'm gonna turn this over to Jamie. She's going to talk about 263A, and this was kind of where the industry first landed early on in terms of how we might be able to help the cannabis industry mitigate 280E. So Jamie, did you want to talk a little bit about this?
Sure. So I just want to go back real quick and just mention that specifically 280E in the tax code, 280E references specifically the Controlled Substances Act. So that's a really important part of our argument, which people may not actually know. They may understand that 280E applies to businesses that are trafficking illegal substances. They may understand that the Controlled Substances Act is what classifies these substances as like illegal, right? But very specifically, there's wording in the 280E code section that says, as defined by the Controlled Substances Act. So that's just an important piece of the argument that I wanted to throw out there. But moving on to 263A, so that's just a code section which basically it involves the capitalization of indirect costs to inventory. And it's kind of funny how it interplays with the cannabis industry, because 263A for most traditional taxpayers actually is something they don't like, because they don't want to be shifting costs from a deductible cost of goods sold, like in the current tax year, to a capitalized inventory cost. It actually tends to be more burdensome for taxpayers than, but for cannabis businesses, it's actually at first was considered to be a really good opportunity to shift more expenses into cost of goods sold. So basically, you say, okay, I'm going to take this indirect cost, let's just say like a facility cost. I'm going to say a portion of that really should belong in inventory. And if it belongs in inventory, eventually it gets deducted as cost of goods sold. And so 263A is actually something taxpayers are bound by, and they are supposed to be doing this indirect cost capitalization. And so in the beginning of, cannabis tax accounting, people said, okay, we'll use 263A, we'll lean on that, we'll take the categories of indirect costs that are kind of required by 263A, and we'll be moving those up to inventory. There is certain language in 263A, it's called flush language, and it basically says, if a cost would otherwise be non-deductible under any other section of the code, then you cannot use 263A to basically create it as a deductible cost. You can't turn it into a deductible cost. And so while some people think that even that language would not actually disallow the ability to shift some costs into inventory, but that gets a little more complicated, ultimately the IRS took the position that yes, that language does disallow cannabis operators from using 263A to shift anything into inventory. And it says right here in the second column here, they issued actually. Oh no, go back. Yeah, they issued what's called a chief counsel memo, and their conclusion was that a taxpayer trafficking in Schedule 1 or Schedule 2 controlled substances must determine cost of goods sold using the applicable inventory costing regulations under Section 471 as they existed when 280E was enacted. And that's kind of a really interesting conclusion. Yeah. 263A came after 280E, and 471 used to be the only inventory methodology, valuation methodology in the code. And so then the IRS was like, no, you can't use 263A, you have to go back to 471. And they actually even said, as it existed when it was enacted, which is pretty crazy.
Which is crazy. That's crazy. So they're saying that you can't use the current regulation. You have to go back to regulation, law that was enacted when 280E was enacted.
Yeah, you have to go back to old, outdated law. It can't evolve.
And so that just reminds me of how the courts and the IRS they get it wrong. I think what kind of sense does that make really? Mm-hmm. Does it anyway? I won't argue the point, but I do. We'll skip to the chase. Just say we can't use this. And I remember.
And I'll just add that that was in 2015, and then a couple years later there was actually a tax court case. And the ruling basically ruled in favor of that IRS position. It said it's Patients Mutual, commonly known as Harborside, and they were arguing they should be allowed to use 263A to value their inventory. And the tax court specifically said, no, it disallows the capitalization of any costs that would otherwise be non-deductible, and they included 280E in that, and therefore it's not allowable. So basically, a couple years into it, it was determined no 263A. Let's fall back on something different.
Right. And I remember that time because it came up and it was prior to this to the patient's mutual ruling. It was out there. I remember going to some continuing education, and we were all sitting around, and we were supposed to get like advice on how do we help these people. And 263A was brought up, but in the tax code, then somebody else brought up, but in the tax code, it says that you can't. And so it was like, well, we can't. And so that made sense to us. Like, we can't do this. So we ended up then moving on to 471. And that was, you know, it was kind of recommended that we look at that, but taking into consideration, but we disregarded the request that we use a 471 interpretation that was in the regulation back in 1980 or whatever, whenever the 280E was enacted, which is crazy, right? So I didn't even know that that was a thing until Jamie, you pointed it out. So obviously we all ignored that and we all went forward with 471 the way it is written in the rules now. And 471 is very similar to 263A, but it's kind of imposed on manufacturing companies to force them to push forward or roll over their deductions and force them to put expenses into inventory that would otherwise be expensed as overhead. And of course, then the IRS or the cannabis industry is like, absolutely, we're going to take those expenses, we're going to move them just like you told us to do into inventory, and then we're going to match our income with the inventory and deduct it as cost of goods sold. And so at that time, given no other options, that is what we started to do. And we started to do these like really complicated square footage schematics and allocating percentages of rent and facility costs to inventory. We started to track payroll. We started to track the employees. If they were in the back bagging and tagging and doing pre-rolls and these kinds of things, then we would deduct that payroll. But when they're in the front selling, we would not deduct that payroll. And it was very complicated. But that was what we had to work with. So that's what we did with it. And in the back of my mind, and I think most practitioners at that time that were doing something, a lot of people weren't doing anything. They were just burying their clients in tax debt, but we were trying to do what we could. We were doing the best that we can, but really, was it defensible? I don't honestly think so.
Well, I'll chime in there and I'll say it sort of wasn't. I think it was reasonable, but in reality, 471 A and the regulations that go along with it, which basically explain how it should be applied, they have really specific. It's different for retailers than it is for manufacturers. It's different for which like farmers, etc. So the retailers, it's pretty specific that they say your cost of goods sold is the direct cost of your product plus like transportation costs. So like shipping costs for it. And that's all a retailer is allowed. So we were kind of taking the position, which is what Harborside did as well, which is interesting to note, that they were saying, sure, I'm a retailer, but I do production related activities. I do manufacturer related activities when my staff is, as Justin mentioned, like bagging and tagging and like prepping product to be sold. They were arguing, okay, we're also kind of a producer, right? And therefore, for that portion of the business, we're going to use the producer rules, which do allow other indirect costs to be included. But in reality, like Harborside was ruled, no, you're a retailer, and that's what you are. Like, you don't get to use the producer rules for you. But in reality, we were like, okay, we have to do something. And this is reasonable. We're not going crazy. We have to ship some into inventory. And I think it was kind of the best we could do. But no, in reality, it probably was not really defensible.
Yeah, and ultimately what ended up happening is when in the few audits that I was involved in where 471A was dispute, or when the IRS auditor or the Court of Appeals or whoever was making it tax adjustments to disallow the overhead, they ultimately were condoned some level of 471A, even though was it truly like, it could have been a bloodbath. No doubt about it. They could have just been like, no. And that's where one audit that I was involved in, that's where they went. They're just like, nothing. And so then we went to the Tax Court of Appeals and they're like, well, what is a reasonable cost of goods sold percentage for a dispensary? Is it 50? Is it 70? Well, really, it's like 30. That's what really it is. But given a little bit of leniency, the IRS was very generous in that regard to be like, actually, we'll let you have a 60% cost of goods sold percentage, which was like, wow, okay, well, thank you very much. Like, I realize you have the tools to make life miserable and you chose not to. Thank you very much. Let's move on. And then so that's kind of that we were on the razor's edge for a long time. But then in 2017, I think was it enacted in 2018 or was it enacted in 2017? The Tax Cuts and Jobs Act.
It was the Tax Cuts and Jobs Act of 2017, but it was applicable to tax years
beginning in 2018, right? So thankfully, like it wasn't intentional, but it was intentional, but not for the cannabis industry, that Congress passed the Tax Cuts and Jobs Act and greatly simplified the language in 471 via 471C to allow us a lot more flexibility, assuming you're under what is currently now $29 million in gross revenue. If you're a dispensary or a cannabis business or any business that's under $29 million, whether you're a retailer or not. So this is what's beautiful about this to start out with, is it no longer applies to just manufacturing. It now applies, it has allowed all businesses under $29 million to have more flexibility in how they calculate their inventory, including retailers, including retail. So that's a beautiful thing. And in the code itself, it says, no, it doesn't say this verbatim, but essentially you can base your inventory methodology on the books and records of your business. And so if we decide, okay, well, we're going to put in payroll, we're going to put in facility costs, we're going to put in expenses that are really important to being able to conduct business. We're not putting in discretionary expenses. We're putting in the things that are required for us to conduct business. And we're going to match our essentially cost of goods sold to income based on the fact that, it requires payroll and it requires facility costs in order to do sales, cannabis sales, in order to conduct business and be profitable. So with that, we restructured our clients' bookkeeping to conform to a more aggressive interpretation, or not interpretation, but we were a little bit what the IRS would consider more aggressive in that we stopped the games with allocating a ton based on exactly what our clients were doing in their dispensaries, and started to cook in or put in the payroll and the facility costs, and then allocate that to inventory and then match it against income through via cost of goods sold, which I know is a complicated topic, but that essentially dropped their effective tax rates way down, much more than 471A even.
And can I chime in for a second, Justin? I just want to mention that 471C, an important thing to note is that the congressional intent, right? What was the intent of this additional code section? And the intent really was, as you can see, it was simplification. It was meant to simplify inventory accounting for small businesses, because it was understood that the vast majority of taxpayers really were actually preparing tax returns incorrectly. They weren't doing their inventory valuation correctly because it was very resource intensive to do it. And it just wasn't realistic for small taxpayers to have the resources to accurately track it and then report it on their tax returns the right way. And so 471C was meant to simplify. And so what we did is we leaned on that congressional intent and we said, okay, sure, maybe you didn't mean it to allow the cannabis industry, right, to get more deductions, but it does simplify it. we're leaning into that. We're not doing these kind of costly like allocations that are complicated and probably inaccurate in reality anyway. And we're just going to move costs that throughout all of accounting, like rules and all of the tax code, except for how it relates to the cannabis industry, those categories of costs are meant to be in some manner included in inventory. And that's consistent through all accounting rules, like labor and facility costs. They like have to be inventoried in most cases. And then you have cannabis and they're just like, it's an exception. And it makes everything, it just like creates this mismatch between like everything. Like cannabis is just this crazy like exception. And so we're like, okay, it makes sense for these categories of costs to be included in cost of goods sold. We're not going to take ones that are never included in cost of goods sold. So we're conforming to accounting standards. And we're also leaning into the congressional intent of simplification by saying we're going to take those categories, but we're going to take 100% of them. We're not going to mess around with allocations. So
right.
Mm-hmm.
So yeah, and at that time that was a spooky thing to do for us. Like we were kind of like, is this too good to be true? And most everybody was like, this seems too good to be true. And accountants especially were like, that's too good to be true. And they just kept doing what they were doing, not realizing that their position, that old way of doing it was less defensible. That's the thing you were saying. It was less defensible. It was very difficult to argue what payroll was, what people were doing where, and like what square footage should be deductible. So we're like, you know what, let's just follow what the law says, make it way more simpler, make it more accurate and more defensive in that way by stop fussing with this. And we're going to include 100% of these facility costs, 100% of these payroll costs. And at that time, that felt, well,
in a way, I would say in a way it was too good to be true, right? Because in a way,
we're gonna get that. We're getting there. Yeah,
the IRS followed up like about a year or so after this was issued in response to like a wave of people in the cannabis industry. It was still wasn't it? Oh, I guess it's here too. Yeah,
this is more language
of people being like 280E is dead because of this loophole, right? That was like a big like.
Well, there were people who were putting all costs into cost of goods sold and not having any decent narrative on, is this actually following Congress's intent? No, this is just a way to get out of 280E. That's what a lot of people were doing with 471C is like, now we're going to just deduct everything. And that, no, you can't, obviously you can't do that, right? You have to have a narrative that supports that you are using this code section to match your expenses to sales. And so discretionary spending like advertising and professional fees are ones that are probably the biggest ones that we don't allow to be deducted, were the things that, we at least didn't deduct, but other people were. And
and so the IRS responded by issuing a regulation. And an IRS regulation is basically their interpretation of the law and how it should be applied in practice. So it's like guidance on how, when the law is not totally clear or where there's nuance to it, the IRS is allowed to interpret and then issue these regulations to guide tax preparers and taxpayers to properly apply that law. And so they issued a regulation and they added this language which said, kind of similar to 263A, which said like if a cost is otherwise non-recoverable, non-deductible, 471C can't be used to like shift that cost to create a deductible cost. So that was interesting and scary at first as well. We were like, uh-oh, I guess we can't do it. But then there was a lot of research and there were tax attorneys in the space who were interpreting this and thinking about this. And ultimately it was concluded by some subset of CPAs and tax attorneys in the industry that the IRS was really overstepping their authority with this regulation. So And that is because the law like the code is the law, and as written, it's pretty simple and it's pretty straightforward. It really isn't very vague. And it just says that if your books and records match what you report on your tax return, then it's appropriate and it's gonna be like okay by the IRS. It's allowed, that tax return is gonna be accurate and it's gonna go through. The regulation was really kind of contradicting that law by saying you couldn't do it a certain way because of other parts of the code. And so a subset of the professionals in the industry moved forward with the 471C approach anyway, but that required more extensive disclosures and just really
elections, making sure that we're doing proper elections. Yeah.
It was a more extensive and like complex process than it maybe otherwise would have been because of these regulation. But
the reason why I wanted to bring in 263A and just not skip over it is because the reason why the industry didn't use that is because in the tax code itself, there was language prohibiting the deductions that were otherwise disallowed by another IRS code section, i.e. 280E. And so the industry, we did not use that because of that language. Now, here they come trying to put a Band-Aid on 471C by introducing the very similar language as what was in the tax code. And most accountants were deterred by it. And they erroneously just went ahead and just listened and was like, okay, and they rolled over. But essentially, the difference is that regulation is not tax code. Jamie pointed this out. They don't write the tax code. They help us to understand what the tax code says, and they provide guidance when guidance isn't available. But there was clear guidance in the tax code. We could read it for ourselves and we understood it. And so then when they put out regulation, which is an interpretation of it, they threw out this blanket language that was very similar to 263A, saying that you can't take deductions that are otherwise disallowed by another code section 280E, but the difference is it's not in the code, and they don't write the code, they interpret the code, and so they overreached. It was very, very clear that they overreached. And since then, the industry, at least a very small portion of us, has continued to do that, and we've heard that that the IRS has not been making adjustments to those positions, and so for 5 years we've been shaking in our boots, wondering, hey, are we doing this right? Are we defying the IRS, and are they going to come and get us? And it turns out no, they aren't. And so, I mean, I'm not saying they couldn't still make our lives miserable, but through audits and bureaucratic things. But as far as like, if this were to be taken to tax court, would they win? Probably not. And that's why I think that the IRS hasn't been taking these to tax court, as far as we know. All right. Okay. So along with that, so we've been moving forward with 471C. We've been saving our clients tons of money because we've been interpreting 471C as it has been written in the tax code, and we've been helping people for a long time. But meanwhile, now we're getting to this point in which rescheduling is imminent from Schedule 1 to Schedule 3, taking it out of or making it so that 280E doesn't apply. And now we've got large multi-state operators amending tax returns, some of which are getting refunds. And so now what should we do now? Like now, we're continuing to use 471C, but is it time to consider not reducing deductions for 280E? Is it time to consider amending tax returns to recapture some of these deductions? And so following is some of the things that have happened federally that kind of point to, has it always been Congress's intent to give sovereignty over cannabis programs to the states? And my feeling is that it has been. we've been bitching about 280E for years. It's like the last thing besides banking, of course, that's like reaping havoc on the industry. Well, also interstate commerce, of course, is something that is difficult for some states more than others. But for the most part, it does seem like it was Congress's intent to give sovereignty to the states with their own medical and recreational programs. And we believe that if argued again at, say, the Supreme Court level, the Supreme Court would probably argue that it is. That states that the Controlled Substances Act should not really apply or be used to enforce federal drug policy on states with their own cannabis policies. So here are some of the things that have happened, and Jamie, chime in if I'm not saying exactly what's happening here, but the Cole memo was a big one during the Obama years, and I remember it was a big deal. And it pretty much the Congress said, hey, and I'm actually not sure if it was Congress or the executive branch, but essentially they were saying like, hey, DOJ, we don't want you to go after cannabis operators for trafficking Schedule I substances when they have their own programs. Okay, we don't want you to do that anymore, and prohibiting them from enforcing the Controlled Substances Act on those businesses, which is like very telling. And then I sit back and wonder why does 280E still apply here?
Justin, when do we talk about Gonzalez versus Reich in this presentation? Because it might be good to start with that.
That's when we talk about Supreme Court stuff.
Okay.
And then now we're touching on non-Supreme Court stuff.
Okay.
And Rohrabacher-Farr amendment was withdrawing funds for and I forget if it was the DOJ or
well, it was a budgeting
yeah,
where it said federal funds could not be used to interfere with these programs.
Yeah. Oh, it was a budgeting thing. Yeah. Okay.
Yeah, it was part of the budget. Yeah. But it did.
Do this whole presentation because.
No, it's true. It did prohibit. I think that's correct. It prohibited the DOJ from allocating any funds.
Yeah, from enforcing. For the enforcement of, again, it's just another one of the Cole memos. The Cole memo was redacted, unfortunately, but still for the most part it was very telling. And then the Rohrabacher-Farr amendment, and then of course just recently the Health and Human Services Department recommended that the DOJ reschedule cannabis from Schedule I to Schedule III. And we have known for years that if proper research was allowed even to study cannabis, and the fact that there are numerous states, most states I think, that have at least a medical program now, that there has to be some sort of medical benefit to cannabis one way or another, whether or not it's a psychological benefit or what are some of the other, there's other ones that'll come to me, but we all know that cannabis is not as dangerous and addictive as meth and cocaine, and I don't even think cocaine is a Schedule I drug, actually. Meth and heroin, for example. So
and of course,
Schedule I is absolutely ridiculous.
Mm-hmm. And right? Of course, recently it actually has been officially requested to update the scheduling. So first it was HHS's recommendation. Now that proposed rulemaking, I can't think of the word of it right now. And now that's officially in the process now.
It's in the process, and it's being hung up. Like there's all sorts of things trying to push it back going on in Congress right now. But if you just use logic, and you ask yourself, well, is cannabis highly addictive and dangerous? Should it have been included in Schedule I drug? The answer is clearly no. And that means that they've had it wrong all these years, and 280 and the cannabis industry has unjustly been suffering the ramifications of 280E. along with many other people who have suffered from the Controlled Substances Act and the war on drugs. But for purposes of this presentation, the injustice of what is 280E and the amount of punitive penalty that the cannabis industry has had to pay. Okay, and then just recently, Joyce Blumenauer amendment. Jamie, you want to talk a little bit about this?
Yeah, this is pretty new. I'm not super familiar with it, to be honest, but basically it was just something that was part of a 2024 like fiscal bill or something like that, that basically just said that
in the military bill or something.
Yeah, and it prohibits the Department of Veterans Affairs, as this slide says, from interfering with veterans participation in marijuana programs. So when there's state it's specifically medical, not recreational in this thing, but it says, you know, they can't lose their benefits. Veterans can't lose their benefits, and they can't otherwise be like prohibited from participating in these programs. It's just another little piece of evidence that, you know, the federal government is trying to allow state legal markets and individuals who want to participate in those state legal markets, to allow that to happen without having any sort of like really negative consequence. And even here, this would be like a federal agency. They're saying the federal agency should not be interfering with these state legal programs. And that's the point of this entire slide, is just to say, similar to as we were speaking of like congressional intent before, what is the intent of the federal government? Because back when state legal markets were first popping up, it appeared that the federal government still did want to regulate those state legal market, and they were trying to preserve their ability to enforce their federal rules on, you know, the states. And we all know that that is not the intent of the federal government at all. And in reality, in the Constitution, where the federal government lacks explicit power and authority to enforce laws, it's intended to be left to the states, right? And so this is just showing how the landscape has changed, where at first it was still very much the federal government has the ability to enforce. People were afraid that they were going to get shut down, even though they were operating, you know, state legal dispensaries and that kind of thing. Now we've seen people more or less be left alone for the vast majority of operations. They're left alone. The DEA isn't coming in and shutting people down for the most part. There's these little pieces of evidence that keep popping up that are prohibiting, in various little ways, the federal government's involvement in the state's programs, right? And so it's showing, like, as Justin mentioned, 280E is like the only thing still there. It's still interfering. And so the argument essentially is that it really shouldn't be there, right? It shouldn't be interfering. So
shouldn't be there. It's a thorn in our side, big time. It's a big thorn. It's a big thorn in our side. And again, they're saying prohibits the Department of Veteran Affairs from interfering with veterans participate in state medical marijuana programs. Why would they do that unless there is some sort of medical benefit? So if there's medical benefit, Schedule 1 should never have happened. And so 280E should have never applied. But yet here we are. We're still struggling with it. Accountants are still afraid to be more aggressive with their clients' tax returns and whatnot. Okay, let's see here. This is just a slide talking about, well, where are we? We've got 24 states in Washington, D.C. that I think I might have got this backwards. We'll just go ahead and skip that. But I think there's 24 states that have medical programs and 17 states that have recreational programs right now. So that's crazy. Okay, here it is.
Okay, yeah, so this is important. This is really important as it ties into the last, topic of the last slide we talked about of the federal, of all the things the federal government has done since this case. Because this case was a case in which, let's see, I don't want to mess up the basic. Basically, at a high level, it was ruled that the federal government did have the authority to enforce the CSA, the Controlled Substances Act, on state-only programs. That's the gist of it. And there was the reasoning was that, well, let me back up a little. So the Controlled Substances Act, the federal government has the authority to enforce the Controlled Substances Act at all because of what's known as the Commerce Clause in the Constitution. And the Commerce Clause is, as I mentioned before, like the federal government needs explicit authority to do things. And the Commerce Clause grants the federal government explicit authority to what's the word, regulate,
to enforce Controlled Substances Act, control the federal laws in states with medical programs.
Yeah, but it's to regulate. It explicitly allows the regulation of interstate commerce by the federal government.
Yeah.
Interstate meaning between states, right?
Right.
And so the argument in this case was that the state program is intrastate. It's not interstate. Yeah. It's intrastate.
We're not allowed to export.
Yeah, we're respecting the Interstate Commerce Clause and the Controlled Substances Act, and that we're not going between states. But the idea was they're overstepping their authority because it's interstate, not intrastate. Mm-hmm. But the ruling was in order to effectively regulate the illegal drug market between states, the government needs the federal government needs the ability to regulate it within the states as well. It was this idea, and it was specifically quoted, I believe, as like uniform illegality, and that was necessary for them to enforce the CSA at all. Okay, so that's where we were in 2005, right?
Right.
Now the idea is that with all those things we mentioned from like 2013 and onward, and also just how little interference we've seen in these operations, just in general, uniform illegality is not there. They're not trying to enforce it. They don't need to, and they're not making it a priority. In fact, they're specifically deprioritizing it based on these little pieces of evidence we're seeing, time and time again. And so there's an argument now, and well, I'll let you, Justin, do you want to talk about like the dissent you usually use?
Well, let's chime in here. Like, so back in 2005, when the Supreme Court upheld the federal's ability to regulate the state cannabis or programs and whatnot, and said, hey, no, we can take you down if we want to. That's what it was. Like, we're gonna keep enforcing the CSA does apply to the states even if they have their own cannabis policies. But there were two people on the Supreme Court at that time. Specifically, Justice Thomas had a strong dissent, arguing that the decision undermines state sovereignty and it's unconstitutional. Essentially, he's saying he believes that it violates the Interstate Commerce Clause. And therefore, he dissented, even though they definitely, upheld that.
The majority rule.
Federal government, yeah. Mm-hmm. Okay. But now we definitely have a different. We're at a different time, right? We have.
In 2005, the Supreme Court was more liberal, and there was and has been, over the last 100 years or something like that, a more expansive interpretation of the Constitution, which was granting the federal government more power to regulate even the states. And that is important for that Reich decision too, because it's similar to, just so to understand the reasoning by the courts, it's similar to environmental policy, where historically the federal government has been able to regulate states specifically and how they do certain things that affect the environment, because ultimately it has a ripple effect across the nation.
Yeah.
And that was the ideology behind that ruling. However, we now have a more conservative Supreme Court, and they are very clearly retracting that expansive interpretation of the Constitution and moving much more towards an originalist interpretation of the Constitution, which restricts the federal government's power. And I'll pass it back to you, Justin.
Oh, well, yeah. Well, just don't look into our company's political leanings one way or another. The fact that the Supreme Court is now almost entirely stacked by conservative Supreme Court judges is not necessarily a decision we made. But the facts are the facts, and they definitely are pulling back and giving more power to the states. And so the idea now is like, hey, if the Gonzalez versus Rice case were to be retried now, or even then, with the Supreme Court as it is now, how would it have ruled? Well, it's easy to answer that question because we don't have just one or two Clarence Thomases. We now have 6 in the Supreme Court, and they have just been reaping havoc.
Yeah, they've been overturning, like very long-standing precedent, and we've seen an absolutely incredible amount of like precedent overturned in like just 2024 alone. But it's been happening, and it's kind of interesting because it's like flipping. Like it's flipping like law on its head right now. Like people don't know how they're going to start interpreting certain laws because things are changing so rapidly. But we're seeing with these handful of decisions that retraction of the federal government's, federal government's power.
And the power of the federal government.
One that was overturned very recently in the last week or two was this Chevron deference, which essentially it granted regulatory agencies the right to like fill in the gaps when law was unclear and create policy that allowed the application of the law. So it basically gave these agencies more power to interpret law and to create policies around it, even when the law was vague. And that is actually pretty important to the 471C position we talked about earlier, because it's kind of showing that the IRS's power and ability, because they are a regulatory agency, a federal regulatory agency, to interpret these laws, where we thought even previously with the Chevron deference still as like a precedent that was being followed, we still felt they were overstepping. But now with that ruling, it seems much more clear they're not allowed to do that right now.
Well, the IRS's ability to regulate has been depowered. Like power has been pulled. It's like it truly is an interpretation of the code versus the IRS saying our regulation is the code if no code exists. And now we're saying now what's happening is we're like, no, IRS, no, you interpret the code, you don't create the code. And in the absence of tax code, we will move forward with our interpretation of the code, and you will have to take us to court in order to argue otherwise. Now, what would happen there is that's a different story. We're not tax attorneys.
Yeah, so, but all that to say that and the point of this presentation is that the landscape has evolved and has changed drastically since the beginning of state legal markets, and especially since that Reich case, which has set the precedent all these years for 280E. Well, from our perspective, 280E, but also just in general for the CSA to apply to these state legal markets. So that's been precedent, long-standing, sort of long-standing precedent, not compared to other things, but 20 years of precedent that now appears could easily be overturned based on.
And the examples are listed here. Specifically, the big one, Dobbs versus Jackson, when essentially they overturned Roe versus Wade and gave power back to the states to have their own abortion policy, essentially. And if they want to ban abortions in their state, they can. And the federal government can't do anything about it. So that was huge. And that was a big shift towards the implication that the Supreme Court would say, no, the states do have the sovereignty over their drug policies, which is big for all drug policies, including the states that have decriminalized, like Colorado, who decriminalized psychedelics, Oregon, that has a psilocybin program now. So that's big. We talked about the Chevron. And then these other ones that I don't know as much, but so Murphy versus NCAA struck down a federal law prohibiting state authorized sports gambling. Yeah, so they're saying no, states have the right to have sports betting if they want to, even though there's online, you can gamble online now. That's definitely interstate. Anyway, we'll move on. Okay, so I think we killed it with our position, and I think we're getting to. Let's see here. Oh, these are some other amendments. Like the Congress has in the Constitution that you can't penalize a business or have excessive penalties for conducting like punitive. Well, I guess I'm not. Jamie, can you talk on this? I'm
yeah,
not sure.
There's a couple. One is like how like a couple other arguments. So one is that businesses and individuals can be taxed on income is one of them. And so
okay, I think that was
one of the arguments is that this isn't a tax on income. This isn't like, it's not taxing an appropriate number, basically. So it's unconstitutional. A tax is unconstitutional because it's taxing on greater than their actual, net gain, right, for their business operations. And then another one is, yes, that you can't assess like excessive penalties, basically. And the argument is that 280E is an excessive penalty.
It's a penalty. Yeah.
Yeah. And so there's
no reason. I mean, I understand where they might have been coming from in the 80s because we had like an incredible organized crime presence in the United States at the time. Just think Las Vegas, think Chicago. We were just coming in, we still were suffering the ramifications of alcohol prohibition. And so organized crime in the United States was very present. So one of the things that they were getting these people on was tax evasion. And like there was like people skimming casinos and doing all sorts of stuff, like making tons of money illegally. And so they wanted to make sure that if we're not able to take them to court and try them for the crimes that they're committing, we're going to get them on tax evasion. And so I think, and I don't know if this is true, we need to read the history book on 280E, but essentially I think it was like to get those people, because now we have an actual code section by Congress saying like, hey, you're going to pay tax on your gross income and you're not going to be able to write anything off, essentially. And they did, and they were able to use it for a long time. And in the 90s, they really they did this big bust. It's very interesting. They did a huge bust and took almost all of the crime families down all at one time. And now in the 2010s, that environment is completely different, but yet we're still left with 280E.
Yeah, okay. Well, and it's so interesting because, right, we've never had a situation until recently that there was this conflict between state and federal laws like this, where there is a state legal industry, but it's federally illegal, right? Like we haven't seen that with drugs before. There weren't drugs that were legal at the state level that were not legal at the federal level. So we're just all trying to catch up and have policy catch up with like what's actually happening, which is these are legitimate businesses and legitimate operations, and they are legal, really. So why are these crazy rules being applied to them? Right?
Alcohol prohibition had something similar, but it was pretty quick. The states were like, now we're allowing alcohol, and then the federal government. But we've never had this long of an argument for something that's actually less dangerous than alcohol. So it's crazy. Let's see here. 10th Amendment. Again, just kind of saying like, hey, 10th Amendment is not granted to the federal government.
Yeah, this is what I spoke to at the beginning, where it says wherever the federal government is not like explicitly granted authority to enforce, something, then
when you were referring to Gonzales,
for the states, if the federal government does not explicitly have the authority.
Yes, exactly.
That's where the Supreme Court and their like either an expansive or whatever the word is versus like an originalist interpretation of the Constitution is so important, because of course there's an argument that the Constitution does grant the federal government indirectly a lot more power than it actually states, right? And that's how it's been interpreted for a long time. But an originalist view is much more like, if the words aren't written on the paper, it's not a power for the federal government.
Right. And we're going to go through this slide deck and make sure that it's updated, make sure that it's 100% accurate. It was like put together kind of on the fly. So what you will find on our website when we finally get the slide deck to where we want it to be is going to be probably a lot more refined and more accurate. So we appreciate your patience on this. But okay, so we need to get a move on. We only have 5 minutes. Trulieve, of course, is what's got the ball rolling in terms of like talking about what do we as a cannabis industry do now. They amended their 2019, 2020, and 2021 returns and got $113 million in refunds, which is crazy. That means the IRS actually gave them refunds. There's speculation as to why they gave them the refunds, that if Trulieve wins that argument, the IRS didn't want to be on the hook for having to pay interest to them on $113 million. And in fact, if the IRS wins the case and Trulieve has to pay that $113 million back, then they are going to have to pay the interest. And but everything to me is pointing to the fact that I don't think the IRS is going to get around to auditing them and taking them to court. They've got like one of the biggest attorney firms in the nation defending them. It would be huge. It would be great. It'd be a great spectacle for sure to watch that go down in court. But I bet you, I'm willing to wager that the IRS does nothing to Trulieve and instead will go after another, smaller companies that don't have the budget to afford to defend themselves in court. And so, but these guys are getting their refunds. Why shouldn't the rest of us in the cannabis industry get their refunds? There's other companies pushing back. Ascend Wellness is refusing to pay tax on 280E. They are amending their tax returns. I haven't heard a lot of people, there's an error there, but with the Canna Provisions Verano, they filed, okay, so this is an interesting one. They tried to say that because it's an interest. Okay, Jamie, I'm going to have you kind of.
They pretty much were arguing what we had. They were arguing, I think, among other things, what we basically spent this presentation talking about. Unfortunately, the case was dismissed. So it's not good progress. It doesn't sound great.
It was dismissed only in that it had been tried before and concluded. So they're saying like really it's dismissed because we don't want you to try to retry this.
Well, I think yes, but also I'm sure it's more complicated than that, right? The dismissal means they didn't think there was there was enough. The argument wasn't good enough to allow it to be tried, essentially.
Yeah.
So,
but maybe they didn't pay enough for their attorneys. But what the court did say, what the judge said, is that although the lawsuit was dismissed, the judge noted that the case presented persuasive reasons for reexamination. Yeah. So that was something. I don't know why they didn't put it through, but the judge essentially said, "Hey, it would be interesting to rejudge that. Why they didn't do it, I don't know why." Okay, so we know that rescheduling is going to happen. It's probably going to happen next year, maybe in the middle of next year. Something like that, if not further down, because the conservatives in Congress are really they're retracting their, I guess, their allowance of state sovereignty or whatnot, or they just don't want to see it a Schedule 3. They want to keep it on a Schedule 1. Who knows why? But essentially, all it will do is remove 280E. It will change cannabis from Schedule 1 to Schedule 3. This conversation is a bigger one. What are the implications? Some people are arguing that we don't want that. We would rather have descheduling altogether. But it sounds like this is what's in the pipeline. 280E, maybe no more in 2015, which is great. Now, what will the IRS do at that point? Will they allow us to not reduce our deductions for 280E for 2015, or will they allow us to go back? I think that they're just going to allow 2015. Some people even say whenever it gets rescheduled. So 280E applies for the first 6 months of the year. 280E doesn't apply for the second 6 months. I think that is absolutely freaking insane, but that is a possibility. They probably will just say like no more 280 as of this year, 2025. So that means 2024 280 still applies, and I don't see the IRS going back and allowing amendments until Congress tells them that they have to.
No, in fact, the IRS issued. I think it's a good time to talk about this news release.
There you go. Here.
So recently, so this is just a couple weeks ago, the IRS actually issued a press release, like a news release, that addressed some of these amended returns that are coming through. It was kind of an interesting news release. They said basically 280E still applies, and these amendments and these claims for refund are not valid. That was basically their position. They spoke heavily to this rescheduling, and their statement was that cannabis has not been rescheduled yet, and therefore 280E still applies. Now, I think we have to assume they're also, without explicitly speaking to it, trying to address these other amendments that are not just like people misinterpreting the proposed rescheduling as actual rescheduling, because that's our interpretation.
It looks like to me that they're addressing, they're telling people.
So yeah, I'm gonna keep going. So yeah, it sounds like they may have gotten a wave of amendments because of the proposed rescheduling, and people misinterpreting that as it's been rescheduled and now 280E shouldn't apply. Now they're saying that's not true. 280E applies until it's rescheduled, and they pretty much said like the date it's rescheduled, 280E will not apply anymore, and everything prior it will. But as I said, I think we have to assume they're trying to indirectly also, speak to exactly what this presentation is speaking to, which is there is a growing movement of people who are moving forward amending returns based on this long, expansive argument about how 280E shouldn't apply, and how the Controlled Substances Act does not apply to should not apply to state legal industries, and therefore 280E should not apply to state legal industries either. And so they are taking the official position that they disagree with those amendments. However, they, at least as far as I am aware of right now, there hasn't been an audit to any of these returns yet. So they can't, a news release there's varying levels of authority that different kinds of guidance have in like the tax world. The code, of course, is the most authoritative, and then regulations are close. IRS regulations are close below that, right? Like the IRS regulations are intended to help people prepare taxes appropriately. So they have a high level of authority as well. A news release is not very authoritative. It's an official publication by the IRS, so it has some authority. It's more authoritative than like an article you find on the internet, right? But ultimately, they haven't issued any regulation that specifically speaks to this. And they also have not actually attempted, as far as I'm aware, to dispute this position for anyone. So really, in order to say no to this, people are filing these amendments. They're filing them with a good argument that they have what's called a reasonable basis to take this tax position, which is really important. And unfortunately, we're pretty much out of time, so we can't speak a lot of that.
Let's take more time.
Yeah. So it basically says it's the reasonable basis does not mean you're sure this is going to be accurate or that the IRS is going to agree with it. But it basically says that you have enough evidence that you believe there's a reasonable basis that this tax position is appropriate and is okay to take. It basically prevents you from being considered like having filed a negligent return or something that was just completely in disregard of the rules. And you can't just say, I think I have a reasonable basis for this and then have one. You have to have a real argument. And then even when you think you have a reasonable basis, it could be determined that other people don't agree that that's reasonable. So there's a risk associated with it. But this, as you can see, or as hopefully you've seen in the last hour, is a pretty well thought out argument that takes into account a lot of different pieces. And I think it would be, personally, I think it would be nearly impossible to argue that there's no reasonable basis for this position.
Right. Yeah.
But it is important to note that the IRS is just, it has to follow the precedent that is out there for it to follow. 280E applies in its like, what's the word? But from the IRS's perspective, 280E applies, and we know that. Yeah. We know they think that.
That's true.
Even prior to this IRS release, we know the IRS thinks that, like on paper, and that's why we file such a long disclosure with our tax return explaining our position. But the IRS can't just say it doesn't work. They have to actually fight it, and then they have to give the taxpayers a chance to take them to court and argue their position. And that's what we have yet to see. So although this news release is a little scary and will absolutely deter many tax professionals and taxpayers from moving forward with this, it's kind of our like unofficial position that it doesn't really mean anything. It's no different than it was before. Like the landscape was no different than it was before. This is just them officially saying something we knew they believed anyway. And it's very similar from our perspective that to but even maybe with less teeth, to the 471C regulation that was issued, where they're going to say something that they know will deter the vast majority of the taxpayers and the vast majority of tax accountants. But they're not actually willing to fight for that, to make that an official. So far. That's what we believe, though, right? So that's kind of how this feels to us. And until we see otherwise, it's our feeling that taxpayers should continue to move forward and give it a shot, really, is kind of what we think. Or at least take some sort of action. So can we move into our action items, what people can do?
Yeah, I think so.
Yeah, so people can basically either amend their tax returns, which is kind of what we're talking about, or they can file protective claims for refund. So protective claim for refund is like basically a taxpayer's request to keep the statute of limitations open, because normally taxpayers only have, in general, 3 years from the date a tax return was filed to amend their return. And then the statute of limitations closes, you can't change it. So a protective claim for refund, if there's some sort of contingency or unresolved circumstance, normally that's ongoing litigation, but it doesn't have to be. Then a taxpayer can speak to that contingency and say, I want to keep the statute of limitations open until that contingency is resolved. And if it's resolved, in my favor, for example, I'm going to amend my tax return to report something different than I have reported right now. So it protects the ability for a taxpayer to reclaim like a refund from a year when the statute of limitations would have otherwise expired.
Yeah, and I think the downside that I don't think we put in here is that I feel like what's going to happen is 280 is going to go away. It's going to be rescheduled. 280 is going to go away. There's going to be taxpayers that amend their tax returns and get refunds. Okay, and then eventually the statute of limitations are going to run out for everybody, and then the IRS and then the people will stop throwing a fit about it, right? It won't apply. You won't be paying millions of dollars in taxes and on phantom income. And then eventually you're going to forget about it, right? And then you're going to move on with business as usual. The IRS will never be held accountable, never address it. The Supreme Court won't retry. Nothing is going to happen. And then eventually the statute of limitations run out. And whether or not you have a protective claim for refund if the IRS or if a decision isn't made to allow you to claim a refund, then this is a good question for you, Jamie. Can we still amend the tax return, but because we have a reasonable basis, right?
Yeah, I think you would just choose then. I think it wouldn't be like a like a slam dunk, right? If there was a contingency that was resolved clearly in your favor, you amend it, they'll pretty much just say, like, okay, we agree.
Exactly.
I think you could still amend and then say, you know, our position is this was resolved, like 280E was like does no longer apply and therefore shouldn't have applied back then. I think you could still do that, but it's not a slam dunk necessarily.
Well, and for our viewers' purposes, we do not know what's going to happen. We've heard of businesses amending refunds and getting or amending tax returns and getting refunds. We are just now amending some tax returns for people. We are also moving forward with not reducing deductions for 280E based on our reasonable basis that we presented here. And if you tell us we didn't have a reasonable basis, you're out of your freaking mind, right? And but the point is, take action now. You have a spectrum of options. We would highly recommend you at least move forward with a 471C approach. We're still doing that, even if we are even like also recapturing deductions or not reducing deductions going forward. We are using a 471C approach. We're still doing that, and then we just get them whatever is left. But there's a lot of options here. But the not doing a methodology is absolutely an insane thing to do. An old 471A perspective where you're doing these like big square footage allocations and these payroll things that accountants are still doing is not necessary. Protective claim for refund, absolutely. Bare minimum for 2020 statute of limitations are coming up unless you happen to be mired, one of those people who are mired in tax debt and haven't paid your taxes yet. You will be able to amend even after the statute of limitations. And then potentially amending if you want to take the risk that it's not going to get hung up, that we're going to get the refunds based on a reasonable basis. The IRS does have to give you your refund or deny it. They can't just sit on it. And the statute of limitations for 2020 are coming up, so they only have so much time to do that. Jamie?
Yeah, and I was just gonna say, if we have any viewers here that aren't our clients, I would just encourage them to try to have an open conversation with their current accountant and see really what are they doing for you and how are they doing it. And it's important, while there's a really good argument for what we have been doing, it also requires, really thorough disclosures, really specific tax forms to be filed to protect you as a taxpayer. It's complex, and it's just important that it's done correctly. Accuracy is so important in when you're taking these aggressive positions. So just make sure you're being protected as a taxpayer too. I mean, we've seen a lot of accountants who just failed to do anything for their clients. We've also seen a lot of accountants who don't really know enough to protect them. So they might be being aggressive for you, but they're not actually protecting you, and they're putting you at risk. So we just encourage you to know what your accountant's doing and make sure you feel confident that they are doing what's best for you.
Yeah. I'm amazed at I'll have maybe a 10-minute conversation, or they saw something, they send it off to their accountant, and their accountant comes back and says, that's a scam. That is an accountant that is being extremely lazy, and doesn't want to deal with it. And
it's important to note that accountants are conservative, and it can sound crazy. I mean, if you're not specialized in
it does sound crazy. Yeah.
And you're reading what you're used to reading as a tax preparer, that's IRS regulations, and that's the tax code just as it reads. And you would think that there's not a basis for this argument unless you're really, you're willing to dive deep. And many tax accountants just don't have the time to do that. So
we don't have the time. There's tax accountants that have general practices where they're doing a lot of different industries. They're doing tax returns for a lot of different industries. Oftentimes they're high volume, low cost types of general practices, kind of like you would go to a doctor who's busy and doesn't have the time to properly diagnose you. But then there's niche accounting practices, and there's a few of us out there that haven't been deterred, you know, that are moving forward, you know, and it really does kind of take that kind of business. You definitely want to be working with that type of person that has like eats, breathes, and sleeps. I don't even know what we're gonna do once 280 is gone. You know, like what are we gonna do, Jamie? I mean, we're just we're gonna have to figure out something else. Like, but anyway, very good, very good. So please feel free to visit us on our website, calixcpa.com. Give us a call, email us. We do these meetings as next Friday. We're not going to do it, but every Friday at 10 a.m. Pacific time. All right.
Hey, bye everybody.
Very good.